This accounting mini lecture covers the Sarbanes-Oxley Act as it relates to internal control. Now, if you've taken accounting or business courses in the past, you've probably heard of the Sarbanes-Oxley Act. It was signed into effect in 2002. Following some of the major accounting debacles that occurred at the end of 2001 in the early part of 2002, such as Enron, WorldCom, Tyco, some of the big frauds that most folks are probably somewhat familiar with. Now, there are many elements to the Sarbanes-Oxley Act. For the purposes of this lecture, we're just going to focus on the aspect of internal controls. So, subsequent to the Sarbanes-Oxley Act, auditors of publicly traded companies are now required to provide an opinion on management's assessment of internal controls. Okay, so let's talk about some basic principles of internal control. First, in order to establish a strong internal control environment, we have to establish clear responsibilities within the organization. This is something that should be documented in writing. It's also important to maintain adequate records. Ensuring assets and key employees are protected, and also to ensure that they are monitored. Separate record keeping from custody of assets. This is typically called separation of duties or segregation of duties. It basically means that we want to separate incompatible functions within the business. We basically don't want one employee to have so much access that they're able to commit fraud and then cover it up so that no one else is able to discover it. So oftentimes that can be accomplished by separating some of those incompatible duties. It's also important to divide responsibilities for related transactions. Again, you don't want one person having too much control. Applying technological controls. A lot of times we'll call these automated controls. And thanks to some of the sophisticated systems that most companies rely on nowadays, it's fairly easy to build in some fairly good internal controls within the system. And then, of course, it's very important to do regular and independent reviews. We often call this the monitoring function. We want to not only establish controls, but we also need to monitor and assess them and make sure that they're functioning as they should be. Okay. Now, let's talk about some limitations of internal control, because we know that even with solid internal controls, fraud can still occur. First and foremost, humans make mistakes. So sometimes internal controls can somewhat be compromised simply because a person makes a mistake. They make a bad judgment call, or maybe they don't necessarily understand exactly what they're doing or what the implications of their actions may be. Another possibility is that a person intentionally bypasses internal controls for personal gain, and that's what we would normally call fraud. And here they call it the human fraud triple threat. We often call this the fraud triangle. It's the three elements that have to be there in order for a person to commit fraud. They have to have some sort of pressure or motivation. They have to have the opportunity, and they have to be able to rationalize their actions in order to commit fraud. Okay. Now, when we're talking about internal controls, ideally we would want as many controls as possible, but the reality is that oftentimes it's somewhat cost prohibitive. So a company wants to make sure that the cost of their internal controls is reasonable in line with the benefits they expect to receive. We don't want to spend more on internal control than the benefit we'll receive from having those controls in place. Okay, and of course, cash is always going to be our most vulnerable asset, so we definitely want to make sure that we protect our cash. We want to make sure that the person with the access to the cash is separate from the person that does the record keeping. We want our cash disbursements ideally made by checks, and we want all cash to be promptly deposited and tracked. Thank you for watching this mini lecture on the Sarbanes-Oxley Act and internal controls.